The banks just got caught playing the longest con in modern finance. They didn't want to compromise, they wanted the time. And the 4 months they spent at the negotiating table were the 4 months they used to build the technology they swore would destroy them. Crypto prices are down today. The Senate Banking Committee just advanced the House passed Clarity Act in a 15-9 bipartisan vote, with two Democrats crossing over. And the response from the American Bankers Association and the broader bank trade groups is exactly what you would expect from people who have just been caught lying to Congress for 2 straight years. They are claiming the Clarity Act could destroy banking in America. They are claiming community bank deposits will collapse. They are claiming the risk is so extreme that the bill needs to be killed before it ever reaches the Senate floor. But every single one of those claims contradicts what the banks themselves are doing behind the scenes. And the people who are paying attention to what they are actually doing, not what they are saying, are the ones who are going to look back at this period and understand what was really happening. Tonight, I am going to walk you through everything that emerged in the last 24 hours. The senators who spoke, the insiders who confirmed, the Coinbase chief policy officer who exposed the bank lobby's playbook on national television, the realistic timeline for when the Clarity Act actually becomes law, and the structural setup the market is now pricing in, even as the short-term price action looks weak. If you get value from this, hit the like button, leave a comment. It helps the channel reach more people who need to see this kind of analysis. But this is the part almost nobody understands. Let me start with where we actually are. The Clarity Act has cleared the Senate Banking Committee, 15-9, bipartisan. The bill is now headed toward a full Senate floor vote. The next stage of the process is reconciliation between the Senate and House versions, which already passed the House in July of 2025, and the realistic timeline for the presidential signature is somewhere in the summer. Senator Cynthia Lummis was direct about the timing on the record. She said it is going to take at least 3 weeks, maybe more. She said she would love to have the bill on the Senate floor in June, but described that as probably pretty optimistic. Translation: the realistic window for the Senate floor vote is late June or early July. The realistic window for the presidential signature is mid to late summer, and the implementation window after signature takes another 18 months for the rulemaking and enforcement to fully kick in. But here is the part the timeline coverage is missing. The fight over the bill in the next 60 days is not about the merits of the legislation. The merits have already been debated. The fight is about whether the bank lobby can extract a few more months of delay to finish building the crypto infrastructure they secretly want to deploy themselves. In the moment, not after careful review, the moment the compromise text dropped. Shirzad's framing was precise. He said the only conclusion you can draw is that the banks never wanted a deal. They wanted the process. They wanted the meetings. They wanted the negotiations. Because every month of negotiation was another month they could keep the legislation off the floor while they used the same time to build their own crypto infrastructure quietly behind the scenes. He called it the innovator's dilemma in motion. The banks know they cannot stop crypto. They know the technology is going to disrupt their core business model. So their strategy is to delay the regulatory framework long enough to give themselves time to build their own stablecoins, their own wallets, their own crypto custody infrastructure, their own settlement rails. And when the framework finally arrives and the door opens for crypto natives to compete, the banks want to walk through that same door with their own products ready. The American Bankers Association just sent a letter to bank CEOs urging them to oppose the stablecoin provisions ahead of Thursday's markup. That letter framed stablecoins as an existential threat to deposit bases. But Shirzad pointed out something the bank lobby's own internal research confirmed, but their public messaging contradicts. Coinbase's analysis shows that for every dollar of stablecoin that enters the system, you get 31 cents of net new credit creation. Stablecoins do not contract credit, they expand it. And the bank lobby knows this because their own internal teams have run the same analysis. So why are they fighting it? Because credit expansion at the system level does not help the specific banks whose business model depends on capturing the interest rate spread between deposits and loans. If stablecoins compete for that deposit base, the individual banks lose pricing power even while the overall credit system grows. The bank lobby is not fighting for the system. They are fighting for their specific position inside the system. And those two things are no longer aligned. The biggest banks already know this. They are not fighting the legislation publicly because they are already building stablecoins themselves. JP Morgan has its own infrastructure, Citigroup has its own infrastructure, Bank of America has its own infrastructure. Every major institution is building the same technology they are publicly suggesting their smaller competitors should resist. The bank lobby is using the smaller community banks and credit unions as the political shield for an industry strategy that the big banks have already decided to execute on themselves. And what happens next changes everything. Senator Pat Toomey, in his interview yesterday, framed the structural problem with maximum clarity. He said the pace of change is increasing and that Washington needs to keep up with it to make sure America remains the financial center of the world as we go through this technological revolution. His expectation for the Clarity Act is that it will ultimately pass the Senate, then either go to conference or one of the bodies will accept the other's version. And he said he believes the bill is on a path to being signed into law this summer. He called the July signing target optimistic but likely. That is the language a senator uses when they have internal visibility into the political math. Optimistic but likely is not a guess. It is a calculation based on the vote counts that are currently being assembled behind the scenes. He also addressed the Federal Reserve transition. Kevin Warsh gets sworn in on Friday. Toomey called the pick a great one. He said this is going to be a new day at the Federal Reserve. He described Warsh as uniquely positioned to bring new thinking and creative thinking and a steady hand to the Fed during a difficult moment in monetary policy. That transition is happening on the same week as the markup vote on the Clarity Act, two of the most significant institutional changes in American financial governance landing in the same three-day window. And the markets are watching both of them simultaneously while the chart prints a quiet pullback that the surface-level coverage is interpreting as weakness. But this is the part almost nobody is connecting. Now let me bring in the deposit migration question because this is where the bank lobby's argument completely falls apart on the math. The claim from the bank trade groups is that the Clarity Act will produce massive deposit flight from community banks into crypto exchanges. The implication is that retail savers will pull their cash out of local banks and move it into stablecoins or crypto products to chase yield. Let me give you the actual scenario. Imagine you have $100,000 in a community bank earning 0.1% in interest. That is $100 in annual yield. Now you have the option of moving a portion of that into a regulated stablecoin product earning 3% annual yield. That is $3,000 in annual yield. The math is not subtle. For a retiree managing a serious retirement portfolio of $1 million or $2 million or $5 million, the yield differential between bank deposits and stablecoin products is the difference between getting $1,000 a year and getting $30,000 to $150,000 a year. Of course, people are going to move some of their capital. The bank lobby knows this. That is why they are fighting so hard. Not because the migration is impossible to manage, because the migration is inevitable and they want to control the on-ramp. But here is what the bank lobby is hiding. The same legislation that allows U.S. retail to move into stablecoins also allows global capital to move into U.S. dollar-denominated stablecoins. People outside the United States who currently cannot easily access dollars will gain access through stablecoin infrastructure. Every dollar that flows into a U.S. regulated stablecoin from outside the country is a dollar that becomes part of the U.S. banking system that was previously outside it. The net effect on the U.S. banking system depends on which flow is larger, and the international demand for U.S. dollar stablecoins is currently larger than the domestic substitution effect. That is the math the bank lobby is hiding from their own community bank members. Now here's where things get serious for the small banks. The community banks and credit unions that decide to fight crypto adoption are not going to be institutions much longer. I am being direct with you because I think that is what the data shows. When the technology genuinely changes how value moves around the planet, when the amount of money being saved on settlement costs is structural, when the friction reductions on cross-border payments are measurable, when the nostro-vostro reconciliation costs that traditional banking depends on get eliminated, the institutions that refuse to adopt the new infrastructure are not competing on a level playing field. They are competing against banks across the street that offer instant settlement, cheaper transfers, crypto custody services, and stablecoin yield products. The customer experience differential becomes too large for the legacy bank to overcome through brand loyalty alone. And the customers begin to migrate, gradually at first, then suddenly. The bigger banks are not concerned about this. They are building the infrastructure that captures the migration. The smaller banks are concerned because they do not have the resources to build that infrastructure themselves. So they are using the bank lobby to delay the legislation, to buy time, to either acquire the technology or get acquired by the institutions that do. That is the actual political dynamic, and the Clarity Act passing is what forces the timeline to move from delayed to immediate, and this is where the story becomes dangerous to dismiss. Senator Angela Brooks broke ranks to vote yes on the Clarity Act. She also said publicly that the bill is still a work in progress. She acknowledged that good faith negotiations had been happening, but she also said there are still issues to resolve. Translation: the bipartisan support is real, but it is fragile. The ethics provisions are still being negotiated. The compromise framework that Tillis and also Brooks built can still be undermined if the bank lobby finds another procedural angle to slow the process. That is why the next 30 days matter so much. The bill is in active negotiation between the Senate floor vote and the reconciliation process. Every senator who is on the fence is being targeted by both the bank lobby pushing for delay and the crypto industry pushing for resolution. The political environment is more aligned than it has been at any prior point, but the alignment is not yet locked in. The institutional players who are tracking this process are not waiting for the alignment to be locked in. They are positioning for the scenario in which it is, and the scenario in which it is produces a presidential signature on the Clarity Act sometime between late June and early August. That signature is what triggers the 18-month implementation window. And the 18-month implementation window is what compresses the institutional adoption timeline across every major bank, asset manager, and corporate treasury in the United States. Now here's where things get serious for the prediction market. Let me show you what the prediction markets are pricing right now. The probability of the Clarity Act being signed into law before the end of 2027 sits at 63%. The probability of it being signed before August is 58%. The probability of it being signed before July is 9.8%. Those numbers tell you something specific. The markets are very confident the bill becomes law within the next 18 months. They are reasonably confident it gets done in the next 90 days. And they are uncertain whether the July 4th symbolic target gets hit exactly. That last variable, the symbolic target, does not change the underlying outcome. It changes the timing of when the price action that follows the signature begins to develop. If you are positioning for the Clarity Act becoming law, you are positioning for an event that the prediction markets are giving better than even odds within the next 90 days and dominant odds within the next 18 months. That is a structural setup, not a speculative bet. And the institutional players are positioning accordingly. And what happens next changes everything for the asset class. Now let me bring in what one institutional voice said about positioning during this exact window. He said the Senate Banking Committee session was surprisingly encouraging. 2 Democrats voting yes was more than people expected. He said he is now leaning back in favor of the Clarity Act passing, and the market is also leaning in that direction. And he made a point that I think is the most important framing for any holder watching this video tonight. He said if Bitcoin continues this correction, if the dip goes lower and we test $70,000 or even below, then by July, when the Clarity Act becomes law, you might get a chance to really accumulate digital assets at solid prices before the legal framework changes the demand curve. Read that one more time. This is an institutional perspective describing the current price weakness as the accumulation window before the catalyst confirms, not as a sign that the thesis is breaking, as a sign that the entry conditions are being delivered by macro pressure before the structural catalyst lands. That is exactly the framework the patient holder applies to every prior cycle. The macro creates the entry. The structural catalyst produces the move. The holders who are positioned through the macro pressure capture the upside when the catalyst confirms. The holders who panic out of the macro pressure miss the move because they sold at the exact moment the institutional accumulation was happening. We are in that window right now. The chart looks weak. The macro looks uncertain. The Iran situation is unresolved. The Fed transition is creating uncertainty. The bank lobby is fighting the Clarity Act publicly. And underneath all of that noise, the structural setup is being completed. But this is the part almost nobody is sitting with. The XRP, HBAR, XLM, and Chainlink holders watching this video know the long view. We have always known the long view. The technology is going to have a profound impact on 8 billion people. The exact scale of the impact is not knowable in advance. The exact volume of value that gets tokenized is not knowable in advance. The exact number of transactions that move on chain is not knowable in advance. But the direction is knowable, and the assets that benefit most are the ones connected to the institutional systems being built around them. XRP is connected to the most extensive institutional system of any major digital asset, the Ripple acquisitions. The Standard Custody Federal Reserve Master Account Application, the OCC Trust Bank Charter, the Beacon Network Compliance Infrastructure, the UKFCA approval, the EU MiCA positioning, the Russia MOEX Index, the Franklin Templeton ETF filing, the institutional credit facility just deployed through Ripple Prime. Every one of those is a structural connection that the broader market has not yet priced into the chart. The patient holder has been positioned for this. The institutional players are positioned for this, the legislative process is converging on it, and the price chart is the only thing that is not caught up yet. Now, here's where things get serious for the tokenization scale. One of the most important framings I have heard from an institutional voice this week came from someone discussing the size of the opportunity in tokenized assets. He said it is not a question of whether tokenization happens, it is a question of when. And then he gave the comparison that puts everything else in perspective. The US equity market is approximately $70 trillion. The current size of tokenized assets globally is approximately $33 billion. That is the entire tokenized asset market sitting at less than 1/10 of 1% of just the US equity market alone. And that ratio does not account for the bond market, the derivatives market, the real estate market, the commodities market, the private equity market. When you look at the actual scale of the financial system that is going to migrate onto blockchain rails over the next decade, the current size of the tokenized asset market is the rounding error inside the rounding error. The migration has barely started. The infrastructure is being built right now, and the assets that are positioned to be the settlement layer for that migration are sitting at fractional valuations relative to what they will represent in the system being built around them. I personally believe we are going to see $50 trillion to $100 trillion in tokenized assets within the next 2 years. That sounds aggressive until you compare it to the size of the broader financial system. $100 trillion in tokenized assets is still a small fraction of total global financial assets. It is just the early phase of the migration that is now confirmed to be happening, and this is where the story becomes dangerous to underestimate. Miles Jennings provided the clearest 42-second framework for understanding what the Clarity Act actually creates. He said the legislation produces 4 distinct categories of digital assets under federal law. Digital commodities, assets that are commodities and not securities. CFTC jurisdiction, digital securities, tokenized securities that fall under SEC jurisdiction. Payment stablecoins, the category the Genius Act has already covered. And non-commodity, non-security digital assets, the category that includes NFTs and similar utility tokens, which get safe harbor protection under the Clarity Act. The taxonomy matters because it determines which assets fall under which regulator, and the assets that fall into the digital commodity bucket, under CFTC jurisdiction with full statutory clarity, are the assets that institutional capital can deploy into without regulatory ambiguity. XRP is positioned to be in that bucket the day the Clarity Act becomes law. The Reg crypto framework that follows is what unlocks retail investor access to assets that were previously limited to accredited investors only. Tom Edwards described this as a major unlock for the broader digital asset market. Tokens that previously had to be issued offshore or restricted to accredited investors will be able to be offered directly to U.S. retail investors under the new framework. That is a structural expansion of the demand base for compliant digital assets that has not yet been priced into any major institutional model, but this is the part almost nobody is internalizing. HSBC's chief crypto officer described the broader timeline shift in an interview that has been circulating for the last several months. She was asked how the time horizon for crypto adoption has shortened in the last 12 months. Her answer was direct. The whole crypto story has been accelerated. The whole crypto story has actually been very fast. Bitcoin's white paper was 2008. We are 16 years in. The US president has essentially said the United States wants to be a global leader and that crypto is going to underpin the new financial markets and the global financial system. In 16 years, if you add AI into the equation, which has natural coordination with blockchain and crypto infrastructure, the acceleration compounds. We are moving toward a world where finance is going to be completely transformed, and the crypto industry is solving the access issue, giving people around the world with an internet connection and a digital wallet the ability to participate in financial markets and access US dollar-denominated assets they previously could not reach. That is the global perspective, from inside one of the largest banks in the world, describing what they themselves are now preparing for. Considering Bitcoin is 16 years old, the assessment was that we are doing pretty well. And this is where the story becomes dangerous to oversimplify. Crypto is becoming mainstream in the United States. It is already mainstream in Europe, the UK, Australia, Japan, the UAE, much of Africa, South America, and Canada. There is a huge global movement of companies, corporations, and retail holders that are moving this industry forward at the same time. The legislative process in the United States is the last major holdout, and it is now in the final stages of being resolved. Sooner or later, every transaction will be handled on a blockchain, every security, every derivative, every piece of debt, every real estate transaction. Everything will be secured, traded, sold, and bought on blockchain infrastructure. The question is not whether the migration completes. The question is how quickly the migration completes. And the speed of the migration is being determined by the legislative and regulatory frameworks being finalized over the next 18 months. If you are positioned in an asset that is connected to the settlement infrastructure being built underneath that migration, the patience required to hold through the consolidation phase is the price of being positioned for the move that follows. The price chart is not the leading indicator. The leading indicator is the institutional infrastructure being deployed. The Beacon Network compliance layer, the Federal Reserve Master Account application, the OCC Trust Bank Charter, the institutional credit facilities, the international approvals, the Clarity Act framework moving through Congress in real time. Now, here's where things get serious for what comes next. What I am watching specifically over the next 30 days is the Senate floor vote timeline, whether the June window holds or whether it gets pushed into July, whether the ethics provisions get resolved before the floor vote or get carried into the reconciliation process, whether the bank lobby finds another procedural lever to extend the negotiation, or whether the political coalition holds and pushes the bill through despite the opposition. I am watching the Federal Reserve transition. Kevin Warsh's first 90 days will set the tone for monetary policy direction. Any signal from the new chairman about rate policy, balance sheet management, or coordination with the Treasury will shift the macro framework that risk assets are operating under. I am watching the institutional flow data, ETF inflows, whale wallet movements, exchange balance changes. Each one of those data points tells you whether the institutional accumulation is continuing or pausing during the current macro pressure. And I am watching the broader market, whether Bitcoin tests $70,000 or holds above $80,000, whether the equity market correction extends, whether the Fed's transition produces a meaningful policy pivot, whether the Iran situation resolves or escalates. Each of those variables affects the timing of the catalyst sequence I have been describing, and what happens next changes everything for the next several years. The structural setup is in place. The legislative process is in motion. The institutional infrastructure is deployed. The international adoption is accelerating. The macro environment is creating accumulation conditions. The technology is delivering on the promises that brought every patient holder into this asset class in the first place. What the price chart looks like over the next 30 days is the noise. What the structural picture looks like over the next 18 months is the signal. And the holders who have been positioned through the consolidation are positioned for the resolution of the signal, not for the daily movement of the noise. We have always taken the long view. The community that holds XRP, HBAR, XLM, and Chainlink understood from the beginning that this technology is going to reshape how 8 billion people interact with the financial system. We did not know exactly how big the impact would be. We did not know exactly how much value would migrate on chain. We did not know exactly how many wallets would be created or how many transactions would clear. But we believed that we had found the right assets. We did the research. We kept learning. And we kept growing the conviction that XRP specifically is connected to the institutional systems that produce the new financial infrastructure. That belief is being confirmed in real time. Every week, every announcement, every legislative step, every institutional partnership, every regulatory framework, every macro alignment, all of it is converging on the same conclusion that the patient holders have been positioned for since the consolidation began. If this video helped you connect the dots that the surface level coverage is missing, hit the like button, leave a comment. Let me know what stood out to you most. Subscribe and hit the bell, because when the Senate floor vote is scheduled, when Kevin Warsh's first major statement lands, when the Clarity Act reconciliation timeline becomes public, when the presidential signature happens, when the 18-month implementation window opens, and when the first major institutional XRP partnership announcement drops under the new framework, my breakdown is live within hours of each event. The technology doesn't wait for the people who fight it. It just keeps moving. And the only thing that determines whether you arrive on the right side of it is whether you understood what was being built while everyone else was watching the price chart. I will see you in the next one.